Welcome to this explainer. We're jumping right into a totally fascinating puzzle today that demystifies the core difference between cash flow and profit, and we're going to do it completely free of any dense, boring academic jargon. If you've ever looked at a business's bank account and thought, wait, why doesn't this match the massive profits reported on paper? Well, you are in exactly the right place. We're exploring source material that breaks this whole concept down using a super practical, real-world scenario. By the end of this explainer, you're going to understand exactly how accountants, investors, and successful entrepreneurs actually view money. Let's get into it.
So let's put on our detective hats and start with a seemingly simple, yet incredibly deceptive question. What actually is profit? Now, I know what you're probably thinking. You might be saying, well, profit is just the cash I have left over after I pay for everything, right? But as we're about to see, the answer to that question fundamentally changes, depending on the exact lens you're looking through.
All right, let's look at a quick thought experiment. Imagine this is your business for a single month. You go out and buy 1,000 items to sell, and they cost you $3 each. Over the course of the month, you crush it and sell 700 of those items, with customers paying you $5 a pop. Meanwhile, just to keep the lights on, your operating expenses for the month total exactly $1,000. And just to keep the math clean, let's assume every single one of these transactions was paid in cold, hard cash.
I want you to actually do the math in your head right now. What is the operating profit? I'll give you a second. Take the money you brought in, take the money you spent, and lock in your final answer. Got it? Because the results of this simple little math problem are absolutely going to surprise you.
Here's the crazy thing. If you give this exact scenario to a room full of incredibly sharp, capable business minds, they will inevitably split into two camps. You're going to get two radically different answers, negative $500 and positive $400. Literally, one group looks at the numbers and sees a business that is bleeding out. The other group looks at the exact same numbers and sees a profitable business that is up $400.
Let's break down Group A first. Their logic is pretty straightforward because they strictly tracked the physical cash that actually moved. First, they looked at the revenue. 700 items sold at $5 each brings in exactly $3,500. Awesome! But then they looked at the cash that went out the door. The business bought 1,000 items at $3 each, spending $3,000 on inventory. You add in the $1,000 for operating expenses, and total cash spent is $4,000. So $3,500 coming in minus $4,000 going out leaves us at a completely logical negative $500. Money physically moved, and there is strictly less of it now.
But then you have Group B. Let's see how they approach the puzzle. They still recognize the revenue of $3,500, but when it came time to calculate costs, they matched the costs directly to the sales. They basically argued, hey, we shouldn't count all 1,000 items as an expense right now because we only sold 700 of them. So, 700 items times the $3 purchase price equals a cost of goods sold of $2,100. Subtract that $2,100 and the $1,000 in operating expenses from the revenue, and boom, you have a positive $400 profit.
So you're probably wondering who messed up the math here, right? How can two completely contradictory answers exist at the exact same time? Well, the truth is, both of these groups are absolutely correct. Group A is totally right from a cash perspective. The physical bank account really is $500 lighter. But Group B is equally right from an economic perspective. The fundamental debate here isn't about bad math, it's about what we're actually measuring.
To solve this mystery, we have to track down the discrepancy that's hiding in plain sight. It's those remaining 300 unsold items. The entire difference between losing $500 and making $400 lies in the inventory we just haven't touched yet. We bought 1,000, we only sold 700. That leaves 300 items just sitting there on a warehouse shelf.
Think about it. Those 300 leftover items, which were originally purchased at $3 each, equal $900 of retained value. This isn't some abstract pie-in-the-sky theory. This is real, tangible value. You exchanged cash for goods, but you didn't set those goods on fire. 300 items times $3 a piece equals a very real $900.
That missing value hasn't vanished into thin air at all. It's simply sitting comfortably inside the business as an asset that the company still completely owns. And honestly, this is exactly why both groups from earlier are technically correct. Yes, the cash is gone, but the value? The value is not. It just changed shape. It transformed from green paper into boxed inventory.
And this is exactly where the math splits. It's the classic showdown: cash basis versus accrual basis. The cash basis just asks one simple question: what happened to the physical money? It records the full $3,000 inventory cost because that's what literally left the bank. But the accrued basis asks something totally different. Did the company create value?
It only records $2,100 in inventory cost because that represents the value of the items that were actually used up to generate the revenue.
So, Group B was using the accrual basis. It's an economic perspective focused purely on value creation, which is exactly how accountants and serious investors measure true profit. When an investor looks at your company, they don't just care about the cash in the register today. They want to know if the underlying engine of your business is actually generating wealth over time. Buying inventory doesn't destroy wealth, it just parks it on a shelf for a bit, and the accrual basis captures that reality perfectly.
To really wrap our heads around this and make it unforgettable, it helps to realize that a healthy business actually operates using two completely different brains. Just like we have different modes of thinking, a successful organization has to constantly alternate between two distinct mindsets to survive and grow.
First up is the cash brain. This brain acts exactly like a cashier looking strictly at a wallet. It stresses over that negative $500 and wonders how on earth we're going to pay the immediate bills. This brain is entirely focused on pure survival. It doesn't care one bit that you have $900 worth of inventory on a shelf because, let's be real, you cannot pay your electricity bill with unsold inventory. It's the mindset of a treasury manager making sure payroll clears on Friday. But then you have the business brain. This brain thinks like a visionary entrepreneur. It steps back, combines that cash deficit with a $900 inventory asset, and sees the overall value that was created. This brain says, hey, don't panic. Yes, we're down $500 in cash right now, but we're holding $900 in highly valuable assets. We are net positive by $400. It understands that wealth was actually created this month.
Now here's the kicker. Every single successful organization needs both of these mindsets constantly working together. You absolutely cannot run a business on just the cash brain. If you do, you'll literally never invest in inventory or equipment because it just looks like a loss of cash. But you also can't run a business solely on the profit brain. If you do that, you might show massive profits on paper while simultaneously going bankrupt because you ran out of the actual physical cash you need to pay your suppliers.
Which brings us to an incredibly powerful metaphor from the source material that really hits the nail on the head. Cash is the oxygen of a business, but profit is the purpose of a business. You need oxygen every single second just to survive. If you run out of cash, the business dies immediately. But you don't live your life merely to breathe oxygen, right? No, you breathe oxygen so you can achieve your purpose. In business, that purpose, the actual economic value creation, is measured by profit.
So, as we wrap up this explainer, I'm going to leave you with this final provocative thought to chew on regarding your own ventures. Which brain is currently driving your decisions? Are you so obsessed with the cash brain, guarding your oxygen, that you're failing to create real economic value? Or are you so intensely focused on the profit brain, chasing paper gains, that you're suffocating your business by running out of the very cash you need to breathe? Finding that sweet spot, that balance, is the true art of business. Thanks for exploring this amazing concept with me today. Keep learning, and I'll catch you next time.